Hi there, I'm Matthew Lester from the Rhodes Business School. There's been a lot of talk around the place recently about the new tax-free investments which SARS and National Treasury have devised to try and encourage South Africans to save. The question is this the right deal that you want? It's immediately very popular with the older investor. They remember times gone by where South Africa did have tax-free savings accounts predominantly provided by the post office. At times when interest rates were high, these did very well, particularly for pensioners. But the situation has maybe changed. Let's look at it like this. Yes, you can get a tax-free investment today, but you are buying it out of after-tax income. And then you will get tax concessions. You will not pay tax on interest. You will not pay capital gains tax when you sell it. And you will not pay dividend tax either. And that sounds pretty fantastic. But let's go into it a little bit deeper, see what this all means. First of all, we have to look at how South Africa's changed. This graph reflects South African interest rates versus inflation rates. And if we go back 10 or 15 years, we see that in the times of Reserve Bank Governor Christels, our interest rate was way above the inflation rate. That's what existed through the 80s and 90s before Tito Mboweni took over at head of the Reserve Bank. And you can see that he brought the interest rate down to approximately inflation rate, and then Jill Marcus took it even further and took it possibly even below the inflation rate. This is a major change in investment strategy. It means that your money is not growing in a bank account even if it is tax-free. And that situation is very unlikely to change in South Africa in time to come. So, we also get tax-free allowances within the Income Tax Act on other investments. Any taxpayer is entitled to receive 23,800 Rand a year in tax-free interest, and those over 65 get 64,500 Rand a year. All taxpayers also get 30,000 Rand a year tax-free income from capital gains. So some investments may be taxable, but they will simply absorb these thresholds and not cause any tax liability. Let's take it a little bit further and have a look at some summaries. So, yes, you can buy a tax-free investment and there's no limitation on the number of tax-free investments, but contributions are limited to 30,000 Rand per annum or 500,000 Rand in aggregate over a lifetime. You can't simply put your entire estate in there. 30,000 Rand a year is going to take a long time to build up. Yes, excluded from the contribution investments are also amounts which you have received on your investments which are reinvested and transfers between tax-free investments. There is, however, no additional tax allowance where a taxpayer withdraws and reinvests funds. Now let's compare this to the retirement annuity fund that we've had around for many years. The important issue is that you buy a retirement annuity fund out of post-tax income. The investment is tax deductible. Yes, from 2016, these contributions will be limited to 350,000 Rand per annum or 27.5% of taxable income. But not many taxpayers exceed that threshold anyway. So you've got a tax deduction on contribution. And then while your funds are within the fund, you enjoy the same tax-free status on interest receipts, dividend receipts, and there's no capital gains tax levied on retirement funds. They're completely exempt. And then for a small kicker on the end of it, if you have a retirement fund and you ultimately die, the benefits will go to your estate, your beneficiaries of your estate without estate duty. That's something the tax-free investment doesn't enjoy. That would be included in your estate. So let's have a look at it as follows. Let's do some numbers here. Right. So we're assuming we're going to contribute 2,500 Rand per month or 30,000 Rand per annum. And we're assuming further that it's going to grow in contributions at 5% per annum over the next 20 years, and we'll get an investment return of 10%. After 20 years, that will be worth a staggering 802,899 Rand. And you might say that sounds very attractive. But it doesn't value in the benefit of the tax deduction. So if we run exactly the same investment and we assume that it is acquired through a retirement annuity fund, now we say, wait a minute, up to 41% of that contribution will come back in the form of a tax refund. And if that is then reinvested over the same 20-year period at the same returns, you'll get a further 329,188 Rand. What you've got to realize about this is that there is a subsidy for saving in retirement in South Africa, but that subsidy does not extend to the tax-free investment. So let's go a little bit further, and we say, right, financial planning has always been about graduate, leave university, and the first thing that you need to do in the new South Africa is ensure your life and your permanent health, etc. Then once we've done that, we get on to a bit of saving, and we've already seen in this presentation that saving returns are very low, and that's a small part of your profile. You then get on to your investments. Investments are generally taxable, and you accumulate those through your life up to retirement. You can have access to them at any time, but you will pay tax on them unless you acquire them in the form of tax-free investments. So that's where there is a gap. And then finally, there are your retirement funds where you're looking to get a tax subsidy so that your money can grow at the expense of government. Now, when you're a young person, you concentrate more heavily towards insurance and savings. And as you get older, we talk about concentrating more towards your retirement. Then we take that and we superimpose it over your lifespan. So you say your milestones in your life are, right, first we get born, and then we spend 25 or 30 years graduating and getting a profession. What's the next big milestone, I ask, and people have all sorts of views on that. My view on it is, one day you're going to retire, and you're going to live for up to 25 years in retirement, and you're going to have to provide for yourself. That's the next big event in your life. In between come the softer issues, I call them, such as marriage, cars, kids, divorces, and all that fun. Then will come the issue that we have to look at, that your parents don't have a big enough pension, so they might come to live with you, along with your in-laws as well. And then even now we are finding that we have to provide for our grandchildren as well, because life's very difficult out there. Where do the investments fit in? If you are looking to invest so as to provide for your kids, your toys, your spouse, your family, etc., and you are wanting to access that money before 55 years old, then the tax-free investment is a good deal. But we have to distinguish that with the idea of providing for life post 55, when you will be retired and struggling to keep or falling on to anybody else. That is where one looks to take the tax subsidy on a retirement fund investment, which has the same attractive tax consequences as the tax-free investment. I'm Matthew Lester at the Rhodes Business School. Thanks so much for your attention.